Today, the debt machine expands some more. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and problem news with a distinctively Australian flavour. We keep coming back to the theme of expanding debt, recalling that excessive debt was a cause of the global financial crisis, but 11 years on, world debt is much higher, 50% higher in fact, which is why we think the risks are higher, and Australia is far more vulnerable, despite the government aspiring to report a surplus soon. And remember, that's a cash flow view, not the total debt burden, which is now more than $560 billion. In Australia, the big concern is household debt, which now stands at around 120% of GDP and nearly 200% of household incomes. And as the housing market has bounced back in the last few months, individual loans have become even bigger. And in fact, the debt to GDP ratios show that, comparatively speaking, Australia has fiscal space relative to some other selected countries, with Japan sitting at 238, Greece at 181, Italy at 135, and the USA at 106. Australia is at 41 and well below Canada at 90, the UK at 85, and China at 51. And the OECD reported recently that globally government debt is now a record high $93 trillion and could become unsustainable. And corporate debt, it notes, is even higher at $101 trillion. And that is a combination of nearly $200 trillion owned by governments and companies. And with lenders now paying borrowers for the privilege of lending them trillions of dollars, the world's financial system is in, well, totally uncharted waters. And the OECD said, should global economic growth and credit conditions continue to deteriorate, a new bout of financial stress could erupt, and the financial markets could become more vulnerable to episodes of contagion. And that's from its latest Global Business and Finance Outlook. But there is one country at the centre of the world's debt mountain, namely the United States, where 17% of global debt is concentrated. Total public and private sector borrowings now top $33 trillion and is rising. And within that, the United States national debt is now over $23 trillion, according to website US Debt Clock. That is the sum of all Treasury securities outstanding, according to the US Treasury, which reported last Friday. Another way to look at it is that the debt per United States citizen is $69,729, and that the debt to gross domestic product is 106.65. Significantly, it has grown fast. Just 8 months ago, it passed $22 trillion, in fact on February the 11th. And over the past 12 months, the United States national debt has jumped by $1.33 trillion. And these are meant to be the good times, not in the depths of a financial crisis. And over the 12 months through the third quarter, the US gross national debt rose by 5.6% from the same period a year earlier. But nominal GDP over the same period rose only 3.7%, meaning that the growth of the debt is outrunning economic growth. And this is President Trump's greatest economy in American history. To bring this incredible growth home, look at recent data from the US Treasury. And I like a chart from Wall Street, which shows how the debt is growing despite the various attempts to check the continual expansion. And there is no end in sight. The final monthly Treasury statement from the US Department of the Treasury to the 30th September 2019 shows the flows in and out. And they reported an $83 billion surplus in September, which includes incomes of $183 billion from income tax from individuals and $60 billion from corporate taxpayers. Remember, those corporate taxes are lower thanks to the Trump tax cuts, and $7 billion from customs duties, including the trade war tariffs. For the fiscal year 2019, the deficit was $984 billion, with income tax at $1,000 $718 billion, corporate tax just $230 billion, and customs duties $71 billion. Again, thank you, China. And these deficits keep coming, with a drop of more than $200 billion in November, February, May, and August, whereas April and September are helped by big personal income tax receipts. But no wonder the debt keeps rising, and of course much of the burden is now paid by your average Joe. So the debt is structural, helped by lower corporate taxes. No wonder the Fed is having to prop up the economy by continually intervening in the government bond market and playing with repos. They're arguably beyond the point of no return. But consider what would happen in a financial crisis during which unemployment will rise and income tax takes fall. Plus, investors may require higher returns on their government bonds. The mathematics of a crisis are horrible, pushing debt yet higher, increasing the costs of debt and driving risks higher again. So it seems to me that the debt monster has been ruling the roost with no way out. And this is not good, and if America catches a cold, then we will go down with a case of economic influenza. Exposed? I would say so. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.